are they here to stay? FIs are back, but are they here to stay? If money is moving out of US, where will it move? Will it go back to India? Will it go back to China? Will it go back to some other emerging market per se? So let's take that conversation forward. And the big question which we are asking is that, are global funds revisiting India? Before I introduce that topic, here's the interplay. We feel that money which is moving out of America, it will go to Europe because it's a rebound trade. It will go to China because it's a tactical trade. But if it comes to India, that means there's a structural backing which is coming for Indian stocks. Gustavo Medeiros joins us now, Deputy Head of Research with Ashmore Investments. And of course, they have a very large India exposure. I mean, it's very well known that Ashmore in India, they've always loved India, haven't they?
Absolutely. Yes, the world loves India. It's the most exciting structural story in emerging markets. There has been for many years, but particularly over the last 10 years, since economic policies have been much more pro-market.
In your strategy in India in last 6 months, net, have you bought more or have you sold more?
So even though we like India structurally, over the last 12 months or so, we kept a tactical lighter exposure. In many equity portfolios, we're actually underweight India for the first time in a few years over the last 12 months. We've used this correction that we've seen to start adding exposure again to India. There was a significant correction on the Indian stock market as a result of the flows that you already discussed, just partially related to global flows as investors reposition their portfolios to cut a little bit of their structural underweight in China, as I'm sure you've discussed in your show many times.
When you say structural story, I would like to take that point forward. What is the best way to invest in a structural story? I mean, is there a benchmark which you used at which you would say that, look, I like India, it's a structural story, and I'm going to pay XYZ price for the structural story?
Look, I think first you have to acknowledge that it's in structural bullish stories, you won't be able to buy stocks overall at cheap levels of valuations, right? So yes, India still trades at a premium to emerging markets, but is a much smaller premium than it was before the correction about 3-4 months ago. Therefore, again, as I mentioned, we start to look into some of the companies that we like to find opportunities. Now, in terms of structural stories, what you want to look into are overarching trends that have many years to play out. In India, for example, one of the trends that we really like is inclusion of women on the labor market and overall kind of like, the ability of India to absorb more manufacturing. I think those are two interesting structural trends, and you need to look into companies that will benefit from that perspective. So just a couple of examples of themes that you look into structural stories to try to understand what are the most powerful vectors of this structural story, and try to actually find the best companies that are the better positions to monetize there in terms of like market. They have a strong market position, say within the healthcare or within appliances for the household sector that will be more demanded as women are spend more time away from home working.
What are your top 3 holdings in India, and where has been and how long your association has been with them?
As you pointed out, I'm the head of research of Ashmore. I do global macro research, so I'm not a stock picker per se. I speak on a weekly basis, at least, with all the equity portfolio managers, but I don't have our current top 3 holding positions in India. What I do know is that, again, as I mentioned, over the last 12 months, we kept a bias towards having companies on the larger cap, which have been trading at lesser expensive valuations, and some companies actually are trading relatively attractive. So financial sector, for example, is things that we're looking at, and obviously if you look at the big companies within India, those are companies that we might have some relatively large exposure as well at the right level of valuation.
So if you have to, let's say, give us a sense of your total emerging market portfolio, are you following the MSCI benchmark in terms of China and India exposure, or you are slightly overweight India from the MSCI benchmark weightage?
So we've been, until a few months ago, overweight China, underweight India, as I mentioned, but we've been in some portfolios covering this exposure. In the pure Indian portfolios, we've been very much biased towards the larger cap companies that have lower valuations and companies that were catering for sectors that were not doing well, but we thought had important drivers in catalysts like the rural area, for example. But again, we've been using this correction and better valuations to cover some of this relative value. In the global portfolios, we've been reducing exposure to China at the margin and adding exposure to India. we're not sure if the correction is over. Overall, if you look at small and medium cap companies, they still trading at one standard deviation reach to their historical levels of valuations when it comes to the last 20 years. But small caps, for example, touched the average valuation in terms of price to earnings over the last 10 years. And again, I think that over the last 10 years, India has been experiencing a much better structural economic policies and has become really the darling of emerging markets. So I think that's a better way of comparing. Therefore, as we started to converge to the mean valuations over the last 10 years, that became an opportunity for us. That's why we started to rotating back to India. And not necessarily getting out of China. In some portfolios, we still have an overweight in China based on the policy trust. But I think that, if you think about global portfolios, I would say that there is still a chance that some foreign investors have been maintaining this underweight China, overweight India. Therefore, this is not a market environment that we wanted to, go very, very big against the theme that we had tactically, but one that kind of allowed for the adjustment of some positions or taking profits or some of these asset allocation views that we had.
If one looks at data points, the estimates are that the US equities have lost anywhere between $4 trillion to $5 trillion. And that's massive by any yardstick. At what point it will start affecting the health of financial market? Because this kind of a drawdown happening so quickly, and given that it is happening in US equities, which is the Indian market or the mother market, I'm sure could have spillover effects on other markets also.
Yeah, so far what's happening is rebalancing of global portfolios away from the US, which is no longer exceptional, as people have been saying for a year, into other places of the world. So we see China and Europe outperforming quite aggressively, up by, close to 30%, more than 30% in China, close to that in Germany, for example, and Europe and emerging markets outperforming the US as a result of that. Look, I think that the big theme of 2025 was the starting point of the year. Everybody had a very overweight exposure to the United States. Nobody believed that you could see any growth improvement in the rest of the world. And people were infatuated with the MAGA policies of deregulation and the policies that would be at the margin constructive, would agree with that. But however, people were buying stocks at the most expensive levels of valuation since 2021, 2001, and 1929. And given the global, when you go and speak to global investors, a lot of investors were aggressively overweight US stocks from a very high exposure initially. US stocks is 70% of global stocks when you look at DM perspective, or 66.6%, or peaked at 66.6 at the MSCI AC, which incorporates EM and DM. If people were aggressively overweight, they were basically all in at the wrong levels of valuations. And we think that some of the stories there were overly priced. So I like the comparison of the current market dynamics in the US with what we've seen in the 1960s, for example, in the Nifty 50 bubble, where you had a lot of good, very large companies that were making quite a lot of money. But there is a key structural element over the last 8 years that explains US exceptionalism, which has been the pro-cyclical fiscal expansion of the United States. The US government spent 5% of the GDP in excess of what they should have spent over the last 8 years since Trump approved the Tax Cut and Jobs Act. And that money was primarily pushed to the private sector. So there's a $13 trillion excess spending from the government within this period, and perhaps not coincidentally, the market cap of the United States of the US was $13 trillion reach. If you look at the trend from 1955 until 2016, and you say, okay, there would have been no exceptionalism if the US wouldn't have spent this money. So in a nutshell, I think what we're seeing is the reversal of that as investors realize that there was actually the policy thrust over the first 60 days of the Trump administration has been all focused on consolidating the fiscal deficit. And this fiscal consolidation has been, in our view, a key catalyst for actually the correction and the end of the US exceptionalism. And I think that's what we're seeing at the moment. This is the main signals from 2025 so far, the over exposure to the United States at very, very expensive levels. And against a backdrop that policy has shifted dramatically in the world. We've seen a historical change in Germany that is going to boil the trade across emerging market countries from Central and Eastern Europe to North Africa to Southeast Asia. A lot of emerging market economies that do business with Europe will benefit from a much higher nominal GDP growth that is coming in Germany and in Europe. And as a result of that, global portfolios will have to rebalance away from the United States. Once that takes place, as that takes place, the dollar weakens. And as the dollar weakens, we actually see a much better environment, not only for investing in portfolios, but also for growth in emerging markets, because a weaker dollar drives foreign banks to lend more money to emerging markets, and that capital flows from the portfolio, from the banking sector, allows for tighter risk premium, which increases potential GDP growth. So people started 2025 with an excessively concentrated portfolio, betting on a policy continuity over the last 8 years, which was US has been exceptionally profligate on their fiscal policies. The rest of the world have been having fiscal policies that were much less conducive to growth. And now we're seeing a complete shift in policy, which the US pointing to fiscal consolidation, the rest of the world actually incentivizing the economies. And therefore, I think we're just starting to see a beginning of a very long-term relative value. That's why I'm thinking, if people had a long Indian exposure versus short China that was structural and it was very similar to their long US exposure, maybe there's going to be a little bit more rebalancing, but the levels of the stock market in India on their own merits are already starting to get to attractive levels from a medium-term perspective. I think that's how I'll wrap up the kind of the main signals from 2025.
Okay, so can I say that India may not be the choice, may not be the best market for 2025 somewhere tactically, or maybe in terms of rebound, it could be a European market or it could be China?
Well, that's the story of 2025 so far. Europe and China have been outperforming, and as I mentioned, we've started to take some profits on some of these exposures that we had, but we're not actually going very, very big overweight India, big underweight China, for example. So yes, as I said, I think that U.S. stocks are still very expensive vis-a-vis their own fundamentals. I think that the market is still far from pricing in a fiscal consolidation in the U.S., which would lead to a deceleration on the earnings per share trend that we've seen over the last 8 years. I call the earnings per share over the last 8 years la la land earnings, because it can only be replicated if the US government keeps on spending 5%, 7% of the GDP in terms of fiscal deficit, and that's impossible to replicate. You can leave that dream for a short period of time, but you cannot leave that dream for too long. Therefore, as more investors rebalance their portfolios, perhaps there will be some more rebalancing to come on the long India versus the rest of the world, opportunities that we're looking forward to actually take advantage of.
So really appreciate your time. We started the show on a note where you say you love India, and I'll end the note by saying that thank you for loving India.
Absolutely. It's a pleasure. Looking forward to speaking again, and good to be here.
Thank you very much. Let's take a break when we...
If you like this video, then like, share and subscribe to ET Now.